for reminding me to record. So I was suggesting before we embark on the questions which we already started with yesterday, I thought it wise that first we look at the question which Daktari gave me so that we can do it. Remember, everything Daktari gives us, we have to look it with 3 eyes, not 2 eyes. So it's my view that we do that question for 5 minutes, or that's, yes, Fatima is suggesting we give them 5 minutes, guys. Fatima is suggesting we give them 5 minutes before we start. Oh, Fatima, no. Was it not? So we continue. We continue. Oh, that's not what. Okay. Thank you. Thank you. Thank you. Guys, we continue. We continue. Yes, yes, yes. Oh, yes. Let's continue. Let's continue. So I was telling you, yeah, thank you, thank you, thank you. I was telling you, there is a question which Daktari gave us. So I was suggesting we look at it first before we go back to where we left yesterday. What do you think? What do you think? Before, yes, yes. Yes, yes, thank you, thank you. Thank you. Yeah, as I was telling you, everything that Harry is giving us, we should look into the 3 eyes and we should repeat it. Yeah, like even 5 times. Yeah, we should repeat what is being done in class. So without wasting time, yes, without wasting time, first of all, there was that assignment which I gave out in the group, in the paid group, the November. I don't know if the November 2018, November 2018 question 4C, and then we will look at this question, May 2019. May 2019, question 5B, question 5B. This question is the one which Daktari gave us. This one I gave out during the paid group class, and it's among those questions which Daktari liked them. So we can start with any of this. We can start with any of this. Did you attempt this question, the November 2018? Did you attempt it? The one for Chilulu. The one for Chilulu industry? No. Thank you. Thank you. No. Yes, then. So we can start with that one. Vera, yes, no, no. Okay, so yes, let's start with that one. Then we look at it, the other one. So can you open your past papers, November 2018 question 4C, question 4C, question 4C. Are you there? Are you there? November 2018 question 4C. Yes, yes, yes. Thank you. Let me read. Chilulu Industries Limited is considering acquisition of Roca Corporation Limited in a share-for-share exchange. The financial data for the two companies are given below. When you read that statement, first you should remember which company is the predator and which company is the target company. That one we know. When you read that statement, you should know that that is the first step to handle a merger and acquisition question. And I believe we remember that. The financial data for the two companies are given below, and you have the data there. Additional information. Chilulu Limited is not willing to incur an initial dilution in its earning per share, EPS. Chilulu Limited will have to offer a minimum of 25% of Roca Limited current share market price required. The relevant offer price, the relevant offer price range, Roman 2, if Roca Limited shareholders accept an offer by Chilulu Limited of 40 shillings per share in a share-for-share exchange, determine the post-merger earnings per share. Using the results obtained in C2 above, and assuming that Chilulu Limited price earning ratio will remain unchanged after the merger, determine the post-acquisition market price of a share of Chilulu Limited. Great. So, to handle a question or to start this question, there are these low-hanging fruits which you should not miss. There are these low-hanging fruits which you should never miss them. So, for example, here you are told Chilulu Limited additional information isn't that, oh, Mercy Wairini, it's, yes, Mercy Wairini, it's November, the question is November 2018. Do you have the past paper link? Mercy Wairini, November 2018, question 4C. Question 4C. Guys, you don't have the, okay. The link for the past paper, I think it's there. Okay, you will, okay, thank you. So, I was saying, you should start with the low-hanging fruits. For example, in this question, under additional information, number 2, Chilulu Limited will have to offer a minimum of 25%. Chilulu Limited will have to offer a minimum of 25% of Roca Limited current share market price. So 25% of Roca Limited current share price. What is the current share price of Roca? What is the current share price of Roca? Guys, from the question, it's 40. Current share price. From the question, 40. 40. 25% of 40. 25% of 40. 25% of 40, 10. Thank you. So this is the minimum. We are told, yeah, a minimum. So this is the minimum offer. From that statement, Chilulu Limited will have to offer a minimum. So this one, 10 is the minimum offer. Minimum offer. Minimum offer will be 10. So here you have your mark. Then now you are required, Roman 1, to give the relevant offer price range. 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 So offer price range, this is NDOP. This is NDOP. Non-diluting offer price. Non-diluting offer price. Are we together, guys? Non-diluting offer price. Yes. So can you remember the formula for this one? NDOP. Guys, can you remember the formula for NDOP? Type there, type. Usiangalie kwa kitabu, just try to remember if you can. NDOP. Give me the formula of getting NDOP. Non-diluting offer price. Non-diluting offer price. Type. The E of predator. Yes, thank you, Catherine. Money, yes. Yes. Great. Yes. Type. Wacha chat ziongezeke. Great. So that is the E ratio of predator times EPS of, thank you, Jacqueline, of target company. So market price per share of predator. Market price per share of predator over earnings per share of predator times earnings per share of target company. Thank you, Monica. Yes, great. So can you give me the MPS of predator from that question? Give me the MPS of predator. And you should know which is the predator company. Give me. Guys. Yosilala, you need to participate. Guys, give me the MPS of predator from the question. 50. Yes, thank you, guys. 50 over. Thank you, Irene. If you can't find it, just let us know. If you can't find it, just let us know. Don't postpone. So EPS of predator, yes, EPS. Give me EPS. Is it 5? EPS now. EPS of predator. We need to calculate. Is it there? Or we need to calculate it? EPS is not given. EPS is not given. We need to calculate it. Thank you. So how do we get EPS? Here you can see there. EPS, the formula is MPS. How do we get earnings per share? Total earnings over nose. 2. This is Mwanza has gotten it. Total earnings. Total earnings over nose, number of ordinary shares. So for Chilulu, no, that's not the answer. Okay, thank you. So for Chilulu, total earnings for Chilulu, 30/6. Odd nose for Chilulu, that will be 5. For Roka, total earnings for Roka, 12. Nose for Roka, divide by 2, that will be 6. I hope we are moving together. So this is EPS. Now, can we bring it here? MPS of Predator over EPS of Predator. Which company is our Predator now? Is it Chilulu or Roka? Guys? Chilulu is our Predator, meaning Roka is our target. So here we are bringing 5. Then we multiply by EPS of the target, which is 6. Now give me the answer. Now guys, give me the answer. The answer there, the offer price range, 60. Everyone, 60. Thank you very much. So we are done. The relevant offer price range. So the range, now the offer price range will be the minimum. The minimum is 10. And the maximum will be 60. Are we okay? Thank you. Has everyone gotten it? Thank you very much. So 10 to 60, this is the offer price range. What is 10? Umi, you've just logged it. 10 is the minimum. Umi, yes. Umi, can you check additional information number 2? Additional information number 2. Can you check that one? Chilulu Limited will have to offer a minimum of 25% of Roka Limited current share market price. 25% of 40. Can you confirm, Umi, if you know where 10 is coming from? Got it. Thank you. So I hope there is no question there. All of us are okay there. So let me rub here so that we can look at Roman 2. Let me rub the look at Roman 2. Look at Roman 2. So Roman 2 is, what is the requirement? Roka Limited shareholders accept an offer by Chilulu Limited of 40 per share in a share for share exchange. Determine the post-merger earnings per share. Guys, can you remind me, when you are given offer price, when offer price is given, what are you supposed to do? When offer price is exchange ratio, calculate normal exchange ratio. Only John and Jacqueline. Only, thank you. Calculate normal exchange ratio. Thank you. That is the first thing you should remember. When offer price is given, you calculate to calculate. Exchange ratio must be calculated afresh. Great, Monica. Yes. So here, yes, use normal exchange ratio. Use normal exchange ratio. And you should compute it, Ruth. And you should compute it. And you should compute it. So normal exchange ratio, we can start there. We can start there. This is post-merger. The question is referring us to post-merger. Post-merger EPS. Post-merger EPS. So let's put down the formula first before we calculate the normal exchange ratio. What is the formula of post-merger EPS before we calculate the normal exchange ratio? Can you type on the chart? This is post-merger. Can you remember something? Guys? Yes, Jacqueline. Remember, you need to do this every now and then. You need to be redoing it. Like a song. You need to be redoing it every now and then. Hata kama unajua tayari. Just redo it. Just, yeah. Mommy, thank you. Nyakundi, thank you. Yeah, that's it. E1 plus E2 over nose of company 1 plus nose of company 2 times exchange ratio. So, yes, Paul. Yes, Paul. So, exchange ratio, the normal now. The normal exchange ratio. So, what is the formula for getting the normal exchange ratio? So that we can compute it and we will put it here in our formula. Offer price, thank you, John. Offer price over MPS of Predator. Thank you, Esther. Offer price over MPS of Predator. Offer price over MPS of Predator. What is our offer price given? Type, guys. We move together. 40. What is the MPS? Okay, thank you. 40 is the offer price. MPS, Liz, is it 50? 50. Thank you. So this is our normal exchange ratio, 4 over 5. 4 over 5. Okay, let's now input our figures here in the formula. So that is 4 over 5. I believe you can remember that. Put it up. So give me earnings for one, E1. Earnings of company 1. 30. Yes, John, yes, exactly. 30. Give me earnings, company 2. 12. Nose for company 1. No. Earnings. Paul. Guys. 6. Nose. 6 plus nose for company 2 plus 2 times 4 over 5. Is this correct? Is this correct? Guys? Yes. Thank you. Give me the numerator. That will be 42. Give me the denominator. Go slowly with the body mass. Go slowly with the body mass to give me the denominator. Go slowly. 7.6, 7.6, 7.6, 7.6. Everyone 7.6, 7.6. Denominator. Thank you, thank you. You are correct then, because all of you are giving me the same answer. So what is our post-merger EPS? What is our post-merger EPS? 5.53, 5.53, 5.53, 5.53, 5.526. It's okay, zero. 5.526. It's okay. It's okay. That's correct. Sawa sawa. We are done. Are we done with that question? Yes, that's it. That's it. That's it. That's it. Thank you. Thank you. Thank you. Thank you. Let's move to the next one. Let's move to the next one. Roman 3. Let's move to the next one. Let's move to the next one. I hope we are moving at the correct speed. I hope we are moving at the correct speed. Kuna wenye walisema they are slow runners, but I believe all of us here, or the speed is right for each and every one of you. So Roman 3. Roman 3. Yes, John, thank you. Roman 3. We are told, let me read. Roman 3, using the results obtained in C2 above and assuming that Chilulu Limited price earning ratio will remain unchanged after the merger. Determine the post-acquisition market price of a share of Chilulu Limited. So the PE ratio of Chilulu Limited will remain unchanged. So using the results above obtained in C above. So here, PE ratio, post-acquisition, the post-acquisition market price per share, post-acquisition MPS. Sawa, post-acquisition MPS, assuming the PE ratio will remain unchanged. So meaning you need to know the formula of getting PE ratio. And what is that? Can we remind ourselves the formula of PE ratio? Type. PE ratio. Thank you guys. Thank you. We are 42 guys. Can you type there? Type yes. Thank you, Esther. John. Thank you, Catherine. MPS over Paul, Vero. Thank you. Yes, thank you. That way you will not forget it. That way you will not forget it. Thank you, Mercy. Thank you. So price earning ratio, PE ratio, is MPS, market price per share over earnings per share. Can you make MPS the subject? Thank you, Catherine. Can you make MPS the subject, guys? Make MPS the subject of the formula. So MPS will be equals to PE ratio times EPS. PE ratio times EPS. PE ratio times EPS. So we know how to get PE ratio. EPS. So let's input our figures here. Let's input our figures here. Let's input our figures here. What is our MPS of the predator? Chilulu. Chilulu was our predator or our target company. 50. 50. I believe, yes, thank you. 50 over EPS of predator. 50 over 5. 50 over 5. Thank you. Thank you. Times. What was our EPS, post-merger EPS we obtained above? 5.53. 5.53. We work with this one. We work with 5.53. 50 over 5 times 5.53. So what is our post-acquisition MPS now? What is our post-acquisition MPS? Give me the answer. 55.3 for Monica. Can you confirm that one? 55.3. Tobias, thank you. Catherine for confirming. Umi. That means this is the correct answer. Umi, yes. Nakundi, yes. 55.3. 55.3. 55.3, Vero, thank you. 55.3. 55.3. 55.3. Great. Now. Yes, thank you, Jacqueline. Thank you, Jacqueline. So kila mtu ndio hivyo, si ndio? Are we okay? Thumbs up. Are we okay? Yes, Velma. Thank you. Thank you for joining. Tobias, thank you, guys. Question, Kamutu. Right? Kamutu, the question. Yes, thank you. Question is November 2018, question 4C. In fact, we are done, Kamutu. Eunice, where did we get 5? Guys, where did we, Ruth, yes, where did we get 5? 5 is the EPS. We calculated the 5 EPS of the predator. Were you not, this means, let me see. Yes, thank you, Mercy. Thank you, Mercy. Yes. Thank you, Mercy. Yes, 30 over 6. 30 over 6. 30 over 6. Over 6. Great. So we can go ahead. Are we together now? Are we together? Can you hear me? The one who was asking about where did we get the 5 from? Don't go to it. No, Eunice, you don't know where we get the 5 from? No target. 30 over 6. We calculated EPS. Which was total earnings over nodes. Yes. So for Chilulu, we calculated. For Roka, we calculated. What was the total earnings? What was the total earnings for Chilulu? What was the total earnings for Chilulu? For Chilulu, it was 30. 30 over 6. This is now how we got the 5 from. And for Roca, it was 12 over 2. And we got 6. Are we okay now? Yes. Thank you. Thank you. Thank you. This is good. You should ask. You should ask so that you know where we are getting these figures from. You should not postpone. So that is okay. That is okay. So I believe we are done now. No question? Yes, Paul. The one who had asked this, are you sorted? Yes, Eunice. Thank you, Eunice. Yeah, you are the one. Thank you. So that is all for this question. That is all for this question. That is all. Yeah, in the MP, how do you get a PE ratio in the MPS? Okay, Kamutu, yes. How do you get PE ratio? Kamutu, PE ratio, the formula is market price per share over earnings per share. Here, when you want to get market price per share, you make MPS the subject of the formula. What is the final answer, please? The final answer was 555. I believe it's from and 3. Keep like that. Keep. Yes, 55.3. 55.3. 55.3. Thanks. Okay. So PE ratio MPS over EPS. Kamutu. So you make this MPS the subject of the formula. So that will be PE ratio times EPS. EPS. So this is how you get the MPS. Remember, EPS is for the target company. PE ratio here is MPS of the predator over EPS of the predator. Kamutu, are you okay now? Confirm so that we can move to the next question. Yes, thank you. Thank you. And thank you for asking. Thank you for, yes, Paul. Great, great. So let's handle, yes, let's handle the question which I have given you, which is May 2019. May 2019, question 5B. Question 5B. Can you put thumbs up when you get that question? Confirm. Thank you, John. Thank you, John. No, May 2019. May 2019. Question 5B. Question 5B. Are we there? Are we there? Are we there? Good. Thank you for confirming. Tobias, thank you. We are there. We are there. Let me read the question. Let me read the question. I believe everyone has got the question. So it reads, Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes during the last several years. In addition, it has used little debt, having a debt ratio of 25%. If the acquisition will be implemented, Excellent Limited will operate Best Limited as a separate, wholly owned subsidiary. This will increase Excellent Limited's gearing ratio to 40%. Gearing ratio to 40%. The following is a forecasted financial data for Best Limited over the next 5 years. So we have that table, year 1, year 2, year 3, year 4, year 5. net sales, operating costs, selling and administration costs, acceptable investment projects cost. Additional information. The risk-free rate of return is 8%, and the debt is considered to be risk-free. 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 Number 2, expected return of the market portfolio is 13%. Expected return of the market portfolio is 13%. Number 3, the firm's levered equity beta after acquisition is estimated at 0.8. Equity beta. Equity beta. I know maybe for the new students, maybe these terms may be new to you, but we shall overcome. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. Infinity, perpetuity. Corporation tax rate is 30%. The firm's gross profit margin, is 40%. Gross profit margin is 40%. Best Limited incurs fixed financing cost of 2 million per annum. Fixed financing cost. So this is a cost, and we should remember to deduct it when we are calculating our profit. The firm's equity shares and bonds are currently trading at par. Required. Determine the maximum price payable to acquire Best Limited using the discounted free cash flow basis. Discounted free cash flow basis. So this is firm valuation. Valuation of firms. Valuation of firms. Valuation of firms in mergers and acquisition. Valuation of firms in mergers and acquisition. In mergers and acquisition. So where do we start? Valuation of firms in mergers and acquisition. Where do we start? Let's come up with it with a table here for the 5 years. The valuation, we need to get free cash flows. Yes, thank you, Jacqueline. Free cash flow. But first, we need to get before the cash flows. Before the cash flow, we calculate profit. Thank you, Adam. Yeah, thank you, John. Profit. We calculate profit first. Thank you, Paul. Yeah? Thank you. Thank you. So, yes. So let's come up with a table in this way. So this is year 1. This is year 2. This is year 3. This is year 4. Year 5. Year 5. Let's come up with a table. We get the profit, and then we will invert our table now after getting the free cash flows so that we can discount and get our price and get our price. So we are starting with the sales. Net sales. Here we are starting with the sales. What is the sales for year 1? Give me the figures, guys. You have the question with you. 50. Year 2. Yes, Jacqueline. 50. Year 2, 60. Confirm. Year 3. 75. Year 4. 70. Year 5. Year 5, 65. 65. This is correct? Yes. I hope we are correct. Let's move together slowly but sure. Uelewe kabisa hii swali, utairudia peke yako tena without referring, uone kama utapata the same, na urudie tena na tena. So, what next now? From the question, what next? What next, guys? What next? I hope you are looking at the question. Less expenses, less expenses, less expenses. What is the first expense? Yes, thank you. Thank you, expenses. Yes, deduct expenses. Thank you. Thank you. What is the first one? Yes, great. Great. Operating, 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 operating cost. Operating cost. Guys, can you look can you look additional information Roman 6? Look at Roman 6. Look at Roman 6. Look at Roman 6. Additional information. Additional information. Additional information, Roman 6. The gross profit margin. The gross profit margin. Catherine, look at additional information, Roman 6. It says the firm's gross profit margin. Can you look additional information, Roman 6? Cost of sales. Great, Isaac. Thank you. Cost of sales. Cost of sales. Cost of sales will be 60. Gross profit margin will be 60%. Can you give me the cost of sales for year one? 60%. Because the gross profit margin is 40%. So the remaining is the cost of sales. Correct? Yes, Velma. Is this for the first? Yes, 30. Elaborate on that. Yes, yes, yes. Let's go slowly. John, there is someone asking here. Velma, there is someone asking. Who was this? There was someone asking here. Yeah, two. Okay, thank you, Velma. Thank you, Velma. There was someone who was asking here for clarification. Irene. Okay. Irene, I'm talking to you. Irene, can you read additional information, number 6, which says the firm's gross profit margin. The firm's gross profit margin. So our gross profit will be 40%. Will be 40% of the sales. So we need to less the cost of sales to get the gross profit. Irene, is that okay? So we take 60% of the sales to get the cost of sales. That's how we were getting 30 and the figures you are giving me. Irene, I hope you've gotten something. Can you confirm? Kosawa. Irene, confirm. Thank you. So give me here the cost of sales for year 2. Guys, it was year 2 is year 3, 45. Velma, start with the year 2. Year 2 was 36. 36. Year 3, yes, John, year 3, 45. Year 4, yes, year 4, 42. Year 5, 39. Thank you, 39. Great. Now we can add the other expenses. We can add the other expenses. So this is the gross profits. Gross profit. Can you less? Yes, was 40%. Yes, thank you, Paul. Thank you, Paul, for helping there. Thank you for helping. So here is 20. Here is John. Next, 24. Next, 30. Next, 45. Next, 28. 28. The last one, 26. 26. Thank you. Thank you. Usichoke, just use your calculator. Get the figures with the rest. Pia wewe usika, yeah? Participate, type, compute the answers, Ndio ukirudia peke yako, you will know how we are getting these figures. Please. So, now let's deduct the expenses. You are telling me, what is the first one here? What is the first one? The first expense you are seeing there. The first expense, guys, the first expense from the question, operating, yeah, okay, operating cost, operating cost. So the first one is 15. Yes, operating S, 5. 5. The next one, year 2, 10. Year 3, 15. Year 4, 12. 12. Year 5, operating 12. No, 15. Year 4 is 15. Year 4 is 15. Year 4 is 12. Year 4 is 15. Year 4 is 15. Year 3. Year 3, John. Oh, 15 also. Thank you. 15 also. Thank you, Fatma. Thank you, Fatma. Year 5. Year 5, 12. Year 5, 12. Tuko sawa? Are we good here? 5, 10, 15, 15, 12. Yes, Fatma. Thank you. What is the next expense? Yes, thank you, What is the next expense? Tumalize. Thank you. Look, admin cost. Okay, admin cost. Tuko hapo. Are we there? Admin cost. Give me the figures. Admin cost, year 1. Yes, thank you, Catherine. Year 1, admin cost, 10. Year 2, thank you, Monica. Year 2, 20. John, that is 10 for year 1. Year 2, 10 again. Thank you. 10 again. Year 3. Yes, thank you very much. Year 3, 8. Year 4, 9. Year 5, 11. Thank you. Yes, thank you. Next cost. Are you seeing any cost? Finance. Thank you. Finance cost. Project cost. Project cost, finance cost. Project cost. Yes, that is number 7. Additional information, number 7. Thank you, Catherine. Note 7. Everyone, can you look? Yes. Can you look at note 7? That is finance cost. Hii wengine wangesahau, hii ni rahisi kusaulika. Finance cost, which is uniform 2 million uniform 2. Are we done with the cost? Tumalize. Are we done with the cost? Yes. Are we done with the cost? Project cost. Tutaeleza hapo chini. Yes. Project cost. Tutaeleza ndio tupate the free cash flows, ndio. Project cost. Tutaeleza ndio tupate the free cash flows. Yes. tutailess ndio tupate the free cash flows, the 0.5. So that is it. That is it. That is it. Can we get the profit before tax? PBT. 3. The project cost tutailess hapo chini ndio tupate the free cash flows. First, let's get the PBT, profit before tax, to less tax, tupate the profit after tax. After hapo then ndio tumalizie. Yes. So Paul, yes. Year 2 is 2. Pole umenipea 1, umenipea 3, then 2. Here is 2. Year 3, 5. Year 4, 12. Year 4 is 2. Year 5, Velma, 1. So this is profit before tax. Profit before tax. And we are given a tax rate. A tax rate, corporation tax, 30%. Less tax. Less tax, 30%. 30% of 3, 1. 30% of 2. 30% of 2, year 2, 0.9. 0.9. Year 3. 30% of 5, 1. Year 1 is 0.9. Is it, John? 0.9. Year 2. Usipotee hapa. 0.6. 0.6. Year 3. Year 3, yes, but 1.5. 1.5. Year 4. 0.6. 0.6. Year 5, 0.3. Year 5, 0.3. So after here, we are getting the profit after tax. Profit after tax, after deducting the tax. This was profit before tax. So here will be our famous profit after tax, PAT. Here, profit after tax. Sini sawa, 2.1. Thank you, 2.1. Give me year 2, 1.4. I don't want to lose any one of you. Number year 3, 3.5. 3.5. Year 4, 1.4. Year 5, 0.7. 0.7. Are we there together? Are we there? Don't lost. Are we there? Are we there? Are we? Yes. Are we there? Usiachwe. Yes, Ruth. Thank you for confirming. Hata umoja, usiachwe. Let's go slowly. PAT, profit after tax. 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 Here, now, get this. There is no depreciation. There is no depreciation to add back. Hatujatoa depreciation anywhere. Hatujatoa depreciation anywhere. Are we together? Hatujatoa depreciation anywhere. So we can't add back We can't add back depreciation to get cash flows. Are we together? We can't add back depreciation here. Perpetuity, we will come to there. We will come to there. Perpetuity will come to there. Get this first. Get this first. Yeah, who was this? Perpetuity asking. Not for perpetuity. Oh, Velma. Velma. Not for. Yes, not for. We will tackle it after. Let me explain here so that you get something here. When you get profit after tax, when you had deducted depreciation, you will add back depreciation to get cash flows, because we cannot discount profit. We cannot discount profit. But here, from the question, there's no depreciation. So if there's no depreciation, your profit after tax will be your cash flows. Is that correct? We are not lessing investment project cost. We are lessing, Joyce. We are coming there. Joyce, we are coming there. We are coming there. Let's get the cash flows first. Let's get the operating cash flows first. Let's get the operating cash flows first. Then we will deduct the retention to get the free cash flows. Tutawatolea pesa yao. Add back investment cost. No. No, Catherine, we will less. So here, this one, because there's no depreciation, this one is your cash flow. 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 So 2.1, 1.4, can't see the board. Fatma. Down. You can't see the board. Oh, down, down. Yes, down. Let me write at the top, at the top. Let me write here. I hope you've written here. So we are saying this is P, profit after tax, because there's no depreciation, which is 2.1, 1.4, 3.5, 1.4, 0.7. So I was saying, this is our cash flow. Because when you reach here, when there is depreciation in the cost, you will add back here to convert profit into cash flow. To convert profit into cash flow, what do? You add back depreciation. When you want to convert profit into cash flow, you add back depreciation. But here, we don't have depreciation. So your profit after tax will be equals to the cash flow. I hope you've gotten that one. So this one is our cash flow. But from the statement, there is acceptable investment costs, which you need to less. You need to less. This one will be retained. You need to less investment or replacement costs. Investment costs. Are we together? You need to less that one, so that at the end you will get your free cash flows for discounting. You are going to get your free cash flows for discounting. You less here the investment cost. Yes. Now, can you give me the investment cost? Tukimaliza, utauliza swali how we are getting the figures if you are lost. So the investment cost, guys, here is 0. Give me the figure 0.5. So we are lessing. Here 2. Here 2. 0.7. Here 3. Here 3. 1.6. Year 4, 1.2. Year 4, guys. Year 4, is it 1.2? Year 5, 0.2. 0.2. Is this correct? So after deducting the investment cost, we are getting our free cash flows, which we will discount them now to get the price we are requested to calculate. So 2.1 minus 0.5, year 3, is there 0.5 year 1 is correct. 2.1 minus 0.5. Oh, the investment cost, is it 0.5? Let me also check. 0.5, 0.7, 1.6, 1.2, 0.2. That's great. Thank you, thank you. Deduct here. 2.1. Help me here. 2.1 minus 0.5, year 1, Velma. 2.1 minus 0.5, 1.6. Year 2, 0.7. Year 3, 1.9. Year 4, 0.2. Year 4, 0.2. 0.2. Year 5, 0.5. 1.6, 0.7, 1.9, 0.2, 0.5. Great. Now, this is our free cash flow. This is our free cash flows. This is our free cash flows, which we need now to discount them. Which we need now to discount them. Remember, we were told to use discount using the discounted free cash flow basis. Discounted free cash flow basis. Can you remember the question asking this? Can you remember the question asking this? If you read the requirement, discounted free cash flow basis. And this is our free cash flows. And this is our free cash flows. Guys, tuko pamoja. Kama umelost, tuambie, tell us. Kama umepotea anywhere, tell us. The requirement was to get discounted free cash flow. This is our free cash flows. Now we want to discount them. Not 4, please. Not 4. We are there. Let me change the bench. I'm back, guys. I'm back. Can you hear me? Can you hear me? I'm back. I was changing the battery. Can you hear me? Yes, thank you, 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 thank you. So, guys, thank you. Nyakundi, Nyakundi. Why less investment cost? Investment cost should be retained. This one is retained for expansion purposes. This one is retained for expansion purposes. Yes, 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 Nyakundi. Investment cost is retained, so you should deduct it. So we have our free cash flows. Let's change our table now. Tunakuja hapo, tutatumia the other information. Let's change the table now. I hope you've written up to here. Let's change our table. Let's change our table. So this is here. This is free cash flow. Free cash flow. Free cash flow. Year one. Will you give me these figures kindly? 1.6, 0.7, 1.9, 0.2, 0.5. I want to drop them down vertically. You will give me these figures of free cash flows. So year one, year two, year three, year four, year five, then infinite. Then infinite. Year one, year two, year three, year four, year five, then infinite. Perpetuity. Perpetuity here. Perpetuity here. 93. The one you are asking, someone was asking. So year one is 1.6, 0.7, 1.9. Year four, 2, 0.2. Year five, 0.5. 0.5. Now, yes, Nyakundi, thank you. 0.5. I hope this is correct. This is correct. Yes. Now, we need to get the infinite cash flow. We need to calculate the infinite cash flow. We need to get the infinite cash flow. And whenever, listen guys, whenever you see infinite perpetuity, your mind should ring this. Provincial officer, PO. Yes, provincial officer, PO. Whenever you see infinite, perpetuity, indefinitely, those three terms. Are we together? That is note number 4. Note number 4. Note number 4. Note number 4 reads like this. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum, perpetuity. So there's growth rate here. Growth rate of how many percent? 6%. Growth rate of 6%. So when you see perpetuity growth rate, you should remember a formula. Can you give me that formula? Guys, type it there. I know it was just in yesterday's class. Can you type the formula there? When you see perpetuity indefinitely plus growth rate and the growth rate given, what is the formula of getting the infinity cash flow here? The infinite cash flow, ndio to discount. Annuity into 1 plus growth over R minus growth. Over R minus growth. Over R minus growth. Over R minus growth. DO. Over R minus growth. KE minus growth. Yes, this is it. I don't know if you will see here. Provincial officer will be equals to district officer into 1 plus growth rate over Kenya minus government. The provincial officer, Kenya minus government. Provincial officer. The PO, Can you remember this formula? Guys, DO into 1 plus growth rate over KE minus government. Yes, 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 yes. So when you see this one, infinity growth rate, you need to use this formula. You need to use this formula to compute your infinite cash flow. To compute your infinite cash flow. So we compute your infinite cash flow. To compute your infinite cash flow. Great. Great, 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 great. Now, guys. There is here another information which you are supposed to use for getting here the KE. The KE. The information, the examiner has given us some information which will help us to get the cost of equity. The cost of equity. Look at additional information. Number 1, the risk-free rate of return is 8%, and the debt is considered to be risk-free. Risk-free rate of return. Then beta, expected return of the market portfolio, 13%, another component. Then number 3, the firm's levered equity beta after acquisition is estimated at 0.8. Ukipata beta, ukipata market portfolio na risk rate of return, hiyo inaitwa CAPM. Hiyo ndio inaitwa the famous CAPM. I don't know if this is the famous CAPM. This is the famous CAPM. Don't worry. This is the famous CAPM. Capital Asset Pricing Model, CAPM. The formula is iandike to risk-free plus into brackets. Thank you, Estelle. Expected return of the market minus risk-free times beta of the security, beta equity, times beta equity. Wacha niandike hapa vizuri. Let me write it here. CAPM, I will run. Let me write it here. CAPM is equals to capital asset pricing model. Capital asset pricing model, CAPM, is equals to risk-free plus into bracket expected return of the market minus risk-free times beta of the security. Kindly write this one, CAPM. So when you are given risk-free, when you see this information in a question, remember this CAPM. When you see risk-free given, when you see expected return of the market portfolio, and when you see beta, remember CAPM. Remember CAPM. Capital Asset Pricing Model. Use it to get cost of capital. Great. Thank you. Sorry. Thank you. Use it to get cost of, tunatumia hii sasa, to get cost of capital. KE. Are we together, guys? I don't know if this is sinking. Repeat the full meaning of the formula. Thank you, Eunice. This formula, Eunice, in a question, when you are given risk-free rate, when you are given beta of the security, when you are given market portfolio, directly remember this formula. Remember, you are required to use CAPM. Remember, you are required to use CAPM to get cost of capital. And this is the formula. CAPM capital asset pricing model, CAPM in full, is equals to RF, risk-free rate of return, plus into bracket, expected return of the market, minus risk-free rate of return, close the bracket, times beta of the security, BS, ndio hii. And this information will be given to you. Like here, the risk-free rate is given additional information, Roman 1, is 8%. 8% plus expected return of the market is given Roman 2, additional information, 13%. 13% minus the risk-free is 8%. Beta is given also under additional information, number 3. The firm's levered equity beta after acquisition is estimated at 0.8. 0.8. Ignore percentage. Give me the answer here. The CAPM, cost of equity. CAPM, KE, cost of equity. CAPM, cost of equity. Ignore the percentage. Give me the answer here. Use your calculator. 12%, Fatima, thank you. 12%. 12%. 12%. 12%. 12%. 12%. 12%. 12%. 12%. 12%. Now, there's another thing. There's another thing. Look at additional information, Roman 1. The risk-free rate of return is 8% and the debt is considered to be risk-free. Debt is considered to be risk-free. That means there is this term. There is this term, WSEC. There is this term. Can you remember this term, someone? Weighted average cost of capital. Weighted average cost of capital. In fact, this one will help us getting the KE, the cost of capital. Malim, kind request, please send the recording to in there. Okay, thank you, thank you, thank you. Let's all be here. This is weighted average. Weighted average cost of capital. Yes, Estelle. Weighted average cost of capital, which is WECE, weight of equity, cost of equity, plus weight of debt, cost of debt. Weight of debt, cost of debt. Tax is given into 1 minus tax. Underline hii mzuri. Valuation of firm, we use Wakaka. Isaac, thank you. Thank you, Isaac. Thank you, Isaac. Underline this one very well. Weighted average cost of capital. Ndio tutatumia here. We will use it here. We will use it here. After getting the Wakaka, the cost of capital, we will use it here. So this formula, weight of equity, WE, cost of equity, KE, which is here. To make calculate KE, KE is here. Look here, CAPM cost of equity, CAPM cost of equity, DOE, WE, weight of equity, cost of equity. Weight of equity will be given. Cost of equity, they calculate using CAPM. Pole using CAPM. Plus weight of debt, cost of debt hizo utapewa. But get this formula. Get this formula. Are we together? Are we together? I hope I'm moving very slowly. I want you to understand this question. Ndio uweze hata kuirudia peke yako. Guys, are you lost? Are you lost? Say something. Guys, you are quiet. Following. Thank you, John. Thank you, John. I'm okay. Yes. Nothing is hard here. So far, so good. Yes. Confidence. Hakuna kitu ngumu. Ni kushika hizi. There is nothing hard here. So, weighted worker cap. Weighted average cost of capital is equals to weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. How do we get KE? How do we get cost of equity? Cost of equity, KE, unatumia the famous CAPM. Ndio tumeandika hapa, CAPM, cost of equity. CAPM, cost of equity, is equals to risk-free rate of return, RF, plus into bracket expected return of the market minus risk-free times beta of the security. Ndio tukapata 12% here. So we need to get the weighted average cost of capital, ndio tutumie in our provincial officer formula to get our infinite cash flow. To get our infinite cash flow. So let's put our figures here. Ndio sasa, if we finish, then you will ask any question. So weight of equity. A capital structure, a firm is financed by debt and equity. Is that correct? A firm is financed debt and equity. Yes. Debt and equity. Look at the first paragraph, the last sentence. Look at the first paragraph, the last sentence. It says, this will increase excellent limited gearing ratio. When you see gearing ratio, this is debt. Gearing ratio of 40%. Umeona hiyo? Gearing ratio is debt. This is debt. Gearing ratio to 40%. It will increase to 40%. So this is gearing ratio. Leverage. This is debt, 40%. So when you have a debt of 40%, to make it complete, what is the remaining 60%? Thank you. So here equity will be 60%. Equity will be 60%. Kwa sababu weight equity plus the debt, the capital structure should be equals to 100. Should be 100. Tuko pamoja? Should be 100. Should be 100. So what is the weight of equity? The weight of equity here. The weight of equity is 0.6. 60%. Yes, 0.6. 0.6 times cost of equity, CAPM, 12% plus 0.2, sawa. Yes, 0.12. Yes. Plus weight of debt. Weight of debt 0.4, 40%. 0.4. Cost of debt. Cost of debt. Ndio hii hapa. Cost of debt. Additional information number 1. The risk-free rate of return is 8% and the debt is considered to be risk-free. Debt is considered to be risk-free. So, if 8%, we use the risk-free. Whenever debt is not given, use risk-free. NB. Anytime, debt, cost of debt, anytime, cost of debt, haujapewa. Listen, anytime, when you are not given cost of debt, use risk-free rate of return as your cost of debt. Hii KD, hapa kwa hii formula ya wakaka. When you are not given cost of debt, KD, use risk-free rate of return, which is 8%. Which is 8%. 8% into bracket 1 minus tax, which is 0.3. That will be 0.7. Let's move here. Let's move. So it will be 0.6. 0.6 times 12% plus 0.4 times 8%. 8% times 0.7. Oh, umeandika fa. Let me write it here. I hope here you will see here. So 0.6 times 12% plus 0.4 times 8% times 0.7. What are we getting as the famous weighted average cost of capital? Can you compute here? 0.6 times 12% plus 0.4 times 8% times 0.7. 0.12. Compute there. You can ignore the percentage. You can ignore the 9.44. Thank you, Irene. 9.44%. Guys, Irene, correct. Can you get that one? 9.44%. Yes. 9.44. Yes. Yes. Velma, yes. Yes. Thank you. Thank you. The rest, are you getting 9.44? Compute this one. 0.6 times, ignore the percentage, you will end up getting 9.44. So 9.44 is our famous weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital. So let's use this one, 9.44. Let's use this one to get our infinite cash flow. So watch out, nifute hapa. Let me rub here. Let me rub here. So we have this one, 9.44. 9.44. Come here. Come here. Provincial officer is equal to district officer into 1 plus growth rate over KE, which will use our cost of capital, weighted average cost of capital, remember that, minus growth rate. Like what Isaac has said, when in evaluation of firms, we use wakaka. We use wakaka here. So this one will be equals to DO, the DO, dividend, current. What is our figure here? Guys, From here, we want to get our infinite. This is the immediate. 0.5. 0.5 into 1 plus growth rate is here. Growth rate is here. 0.06. 0.06 over our wakaka is 9.44. So it will be 0.0944 minus 0.06. Are we together here? How we are coming with these ones? This is our growth rate. Our growth rate, we are told, is 6%. Additional information number 4. G, growth rate, 6%. 6%. Are we together? Yes, yes, John. Only John. Are we together here? Can you look at these figures and see if there's any figure you don't know how to get it? Yes. DO is 0.5. Current dividend. DO is 0.5. The current dividend. Current dividend per share. DO. The current is 0.5. DO is current dividend per share. So what is our answer here? What is our answer? Please explain to them why you have used wakaka in place of KE. In place of KE. In place of KE. KE is cost of equity. In evaluation, when evaluating firms, in evaluation of firms, we use the average cost of capital. Yes, Irene, 0.5. 0.5, the immediate. In evaluation of firms, we use the average cost of capital. We use the average cost of capital. Current dividend over 5, yes. We don't use the CAPEM. We use CAPEM to get that. We only use KE, the CAPEM, the KE, when we want to get the average, the weighted average cost of capital. So what is our figure here? Can you compute here? Can you compute here? 0.5 into 1 plus 0.06 over 0.0944 minus 0.06. Guys, you have the calculators. What is our infinite cash? What is our infinite cash flow here? Our infinite cash flow. Where are you guys? John. Velma, where are you? 15.4, 15.4, 1, 15.407, 15.4. 15.41. Let's work with this one. 412, 407. It's okay. Tobias, it's okay. Just rounding off errors. Yes, we can use that one. Catherine, it's okay. Now, we need to discount this one. These are our free cash flows. These are our free cash flows. And you can see they are irregular. They are irregular. So we use PV. They are irregular. So we use PV. We use PV. At what rate? At what rate?
The cost of capital is ile the one we have calculated, the weighted average cost of capital. Ndio unatumia hapa. We are valuing this firm. We are valuing this firm using discounted cash flow. We are valuing this firm. So here you will use 9.44%. The cost of capital, we have calculated the average, the weighted average cost of capital. Ndio tatumia ku discount hii. Don't use this one, the other one. Don't use the other one here. When we are valuing these firms, we use the weighted average cost of capital to value. So use this one, 9.44. So here, the formula, you remember, PVF is 1 plus R raised to negative N. So here it will be 1.0944 raised to negative 1, 1.0944 negative 2. This is year 2. Sindio. 1.0944 raised to negative 3, 1.0944 negative 4, 1.0944 negative 5. Can you use your calculator now to give me the discounted cash flow? Discounted cash flow here. Discounted cash flow. Can you compute? The first one, 0. This one is 0.991. Let me see. Monica, that is for... Oh, you are fine. Oh, hey, let me return you back. Give me for one, please. Musende Araka, 0.9137. This one. Can you compute this one? 1.094 raised to negative 2, 0.8349. Here. 0.7629 here. Year 4. 0.6971. Year 5. Year 5, Isaac. 6370. 0.6370. What about here? Infinite, you drop down, 0.6370. Can you multiply now to get, our discounted cash flow? Can you multiply now to get our discounted cash flow? Present value. 1.46, 2 decimal place, okay, that's okay, 1.46, next one, 0.58, the third one, multiply, 1.9 times here, times these ones, 1.45, 0.14, 0.14. The fifth one, 0.32. And the infinite one, 9.82. 9.82. Now, these are from the same mother. Now you can add them to get our total present value, which is the value of the farm. The value of the farm. The value of the farm. Can you give me the total now here? 13.77. 13.77 is the value of our farm now. Let me rub here. The value of the farm. The value of the farm as required is now 13.77. 13.77. And that is what was required in that question. Guys, wapi mepotea sasa? 13.77. Yes, Nyakundi, Isaac. I can see. Isaac, Irene, are you okay? Umi, Estelle, Velma, Vero. Vero ameenda. Estelle, John. Yes, guys. Very okay, John. Okay. Mwanza. Monica, thank you. Thank you. Thank you. That was what was required. Estelle, thank you. Thank you. Thank you for confirming. Thank you for confirming. Thank you for confirming. Thank you for confirming. So that was what was required. And is there any question? Is there a question? Is there somewhere you did not understand how we got the figures? Is there somewhere you did not understand how we got the figures? We will end with this one. We will end with this one because of the time. I can see people are moving out. People are moving out. But please, please, have you gotten this one? I didn't see where you got 0.5. 0.5, Velma. 0.5 here. It was a good discussion. Thank you, John. Thank you, John. Velma is asking 0.5. Velma, the dividend of year 5. Yes, John. Velma, 0.5 is dividend of year 5. This one, year 5. DO, yes. DO. DO. I hope we are okay. I hope we are okay. If you have any problem, with getting the figures, just ask where we are getting the figures. Velma, yes, we do. We use dividend. Thank you, John. We will help each other, so that we can pass this paper. We can pass this paper. So thank you very much for attending this discussion, although the number is low, but it's upon a person, it's upon one to wake up, to sacrifice. So I believe hata kama imekaa ngumu somewhere, you've gotten something here. You've gotten something here. The concept, in fact, the concept and the formulas, very important, very important. The formulas. You will understand more. Yes, you will understand more about CAPEM to Kisonga. You will understand more about CAPEM, but irudie, just repeat on this one. Try to do it yourself to see if you'll arrive at 13.77. Repeat it. You can imagine inaweza letwa the same question the same question, we change to something. But if you have practiced it, if you have practiced it, you know where you are getting the figures, you know where to apply the formulas, you will be okay. You will be okay. It will save you this one. It will save you. Don't just say it's hard. Is it dividend in this case, free cash flow? Yeah, 5. Yes, this formula, Velma, we will be using it. Even in other areas. This formula, the PO Velma will be used not just here in evaluation of firms in mergers and acquisition. We will use it in other areas. This famous PO. So guys, Velma, I hope you can get the noted. Thank you. We shall overcome. Thank you. Just sacrifice. Wake up. We do this. Go and repeat it on your own. Try to see if you can arrive at the final answer. Try to see if you can arrive at the final answer on your own. If you can't get there, try to get help so that when you repeat it on your own, you can arrive at the final answer. In that way, you will gauge yourself that I have gotten the concept. In that way, you will gauge yourself that you have gotten the concept, and it shall be well with you. Don't worry, have confidence. Just have confidence. Let me stop this recording. Yes.